This could be a unique chance to build wealth and grow your net worth significantly. Are you ready to take advantage of this recession and be wealthy? You only need knowledge and skills. I am telling you that now is the perfect time to capitalize on this opportunity and make the most of the recession. The old saying, "Riches are made in recessions," has been around for a while, and we may be headed in that direction. Welcome back to Financial Flipside, where we help people with their personal finances and tackle everything about finance and financial literacy. To watch related videos and content, hit the subscribe button and the notification bell to get alerted when new videos are posted. Before we discuss the best upcoming opportunities, it is essential to comprehend the challenges you may face. To begin, let us dive into a conversation about an economic recession. Generally, recessions are characterized by a sharp rise in unemployment numbers, reduced wages, decreased consumer confidence, and decreased value of items such as food, stocks, services, and energy. Second, during periods of economic recession, a decrease in income is commonplace. Recently, organizations have been publishing their quarterly revenue reports and delivering lowered guidance on future growth projections, indicating an increased risk of recession compared to 10 years ago. Third, a round of jobs being cut. Reduced consumer spending due to lower incomes often results in companies cutting back on expenses. Consequently, employees are usually the first to be laid off. With this knowledge, you can use it to make more innovative investments and generate a higher return. The next question is, where to put your investment? Number 1, stocks. Stock is a type of financial asset that represents ownership in a company. Generally speaking, the stock market reaches its lowest point when investors start to capitulate. We need to address the second option, which is real estate. The opinion of Wall Street experts has recently been that housing prices across the nation will decrease by 7%. If interest rates keep going up, there's a chance that this decline could reach 10 to 15%. People considering investing in or buying property may start coming across some appealing deals soon. The third option is related to cash. Up until now, cash has been viewed as slowly losing value to inflation. But when other investments are losing their worth, storing one's wealth in cash may be best, since it appears to remain stable. During times of economic downturn, there is a chance to seize an extraordinary opportunity. Prices for goods and services drop considerably, which presents an excellent opportunity for businesses to benefit from these reduced costs. Warren Buffett had the perfect analogy for this. When hamburger prices go down, we sing. When they go up, we weep. For most people, it's the same with everything they buy in life. Except for stocks, when their prices go down and people can get more for their money, they don't seem to like them anymore. It's important to shift your perspective regarding a market downturn. That's the first one. A bear market can actually be beneficial and work to your benefit, so keep that in mind. Second, during tumultuous times, many businesses experience a decrease in competition due to financial difficulties, organizations ceasing operations, or simply taking measures to ensure fiscal security. This can create an advantageous situation for those still operating in the market. The third advantage of a recession is the abundance of opportunity. It gives strong businesses the scope to excel further and helps weed out weak organizations that cannot stay afloat. It is challenging for entities at the lower market levels to compete and expand due to their limited resources. Fourth, bull markets follow bear markets. A bull market is a sustained period when investment prices are rising in a financial market. A bear market is a sustained stretch when investment prices are falling. Purchasing stocks when prices are down can be more profitable in the long term than exiting the market and waiting. Lastly, it's critical to act before others recognize a recession. Unfortunately, recessions are not declared until long after they have begun. However, you'll notice it in the markets. An example is the Great Recession, which started in December 2007 but was only officially announced a year later. Hey there! Are you enjoying this video? If so, don't forget to like and share this video. Your subscription to this channel would also be helpful for you to learn more about financial topics. And if you want to learn about similar topics like this one, hit that subscribe button. But now, let's continue the video. But how could this be leveraged for potential financial gain? First, cut back on expenses. To ensure your business remains competitive, it's important to stay mindful of the latest market trends. Cut back on high costs and operate efficiently while reinvesting as much as possible into the market. It's essential to have a plan of action for any potential income drops of 20 to 50%. It's important to consider ways you can make up the difference and what proactive steps you can take now to guard against an income decline. For example, let's say you run a small restaurant business that has been struggling to maintain profitability due to rising costs and increased competition. To cut back on expenses, you decide to reassess your menu offerings and make some strategic changes. You analyze which items are the most popular and profitable and which ones are not selling well. Based on this analysis, you decide to remove some of the less popular items from the menu and focus on promoting the more profitable ones. Second, it is advisable to always keep some cash with you for any unforeseen circumstances. Even though investing money as soon as possible reaps the most benefits, having a cushion of extra cash gives you peace of mind and confidence about your financial stability. For example, let's say you have just received your paycheck and have decided to invest a portion of it in the stock market. However, before you invest, make sure to set aside some cash for any unforeseen circumstances that may arise. You calculate your monthly expenses, and based on that, you set aside enough cash to cover 3 months of living expenses. This cushion of extra cash gives you peace of mind and confidence about your financial stability. Third, it is essential to ensure your career stability to protect yourself during difficult times. When the market is unstable, you will always have peace of mind knowing that your career has been secured. This can be a great financial safety net during dire times. For example, let's say you work in the entertainment industry, which is known for its ups and downs. To ensure your career stability, you decide to take some additional classes to enhance your skills in audio production. You also network with other professionals in the industry and volunteer for projects that showcase your expertise. By doing so, you increase your chances of finding work during lean times as you have diversified your skill set and expanded your network. This ensures that you have a backup plan in place should the industry experience a downturn. As a result, you can enjoy greater peace of mind knowing that your career stability is secure, which can serve as a valuable financial safety net during difficult times. Fourth, after short-term goals have been achieved, investing in the long term is important. Investing in such uncertain times can be daunting. However, one of the most effective ways to maintain your wealth is through a strategy known as dollar cost averaging. This involves buying into the markets regularly, regardless of short-term fluctuations in prices. This will not only help you keep your money safe, but also maximize your profitability in the long run. For example, Let's say you decide to invest $500 per month in a mutual fund that tracks the S&P 500 index. If the market experiences a dip in price one month and you invest $500, you would end up buying more shares at a lower price. Then, if the market rebounds the next month and you invest $500 again, you would end up buying fewer shares at a higher price. By consistently investing $500 per month, you will end up with an average cost that balances out the highs and lows of the market, helping you maximize your profits over the long term. Fifth, invest in a variety of assets to reduce risk and maximize returns. When the value of your investments decreases by 20%, you might experience fear or panic, which is a sign that you need to diversify your portfolio. A diversified portfolio with multiple sources of income is less likely to suffer a complete failure due to one unforeseen loss. For example, let's say you have been investing primarily in the stock market, and your portfolio has experienced a significant decline due to a market downturn. To reduce your risk and maximize returns, you decide to diversify your portfolio by investing in a variety of assets, such as real estate, bonds, and mutual funds. You purchase a rental property that generates passive income, invests in bonds that provide steady returns, and add mutual funds that track a variety of different market sectors to your portfolio. Those are the pieces of information you need to know what to do to take advantage of the recession. First, you need to understand what a recession is. This part includes a discussion of the following. Number 1, diving into a conversation about an economic recession. Number 2, a decrease in income is commonplace during a recession. And number 3, a round of jobs is being cut during a recession. Second, you need to know where to put your investment. Number 1, stocks. Number 2, real estate. And number 3, cash. Third, what are the excellent opportunities during a recession? Number 1, it works to your benefit. Number 2, decrease in competition. Number 3, abundance of opportunity. Number 4, bull markets follow bear markets. And number 5, act before others recognize. Fourth, how could this be leveraged for potential financial gain? Number 1, cut back on expenses. Number 2, keep some cash with you. Number 3, ensure your career stability. Number 4, investing in the long term. And number 5, invest in a variety of assets. Thank you for watching our video. Don't forget to like and share this video. To be more knowledgeable about financial topics, make sure to subscribe to Financial Flipside and hit the notification bell to get alerted when new videos are posted.